Welcome to FinTech News Agency. Today, we're focusing on the S&P 500 and the complex signals it's sending. Are we on the brink of a major market downturn, or could the Federal Reserve step in to stabilize the situation? Let's break it down. Recently, the S&P 500 has broken below a significant price channel support level, a move that has been almost a year in the making. But this isn't just another market correction. We've observed a steepening of the U.S. yield curve, which is typically a precursor to an economic downturn. When we see the S&P 500 declining while the yield curve steepens, it's often a sign that financial markets are bracing for a recession. Over the last few months, we've seen the stock market drop by about 10%, and this steepening yield curve could signal a more significant correction ahead. Market valuations are incredibly high, with the S&P 500's Shiller PE ratio still above 30, higher than it was before the 1929 crash. Historically, such elevated valuations have only normalized during recessions, suggesting that a U.S. economic downturn could lead to a 40 to 50% drop in stock market valuations. This puts the S&P 500 at serious risk of entering a prolonged bear market. Unfortunately, we don't have a crystal ball on this channel, but the picture isn't entirely bleak. The VIX, a key indicator of market volatility, has spiked dramatically in recent trading sessions. Historically, spikes in the VIX above 30 have often marked significant market bottoms, sometimes leading to strong rallies. The Federal Reserve, known for its aversion to high market volatility, has frequently responded to such spikes by cutting interest rates. Could we see a repeat of this pattern? There are two potential scenarios to consider. If the U.S. economy is on the brink of a recession, any interest rate cuts by the Fed might provide only temporary relief. This was the case in 2007, when initial rate cuts led to a short-lived rally before the market ultimately collapsed. On the other hand, if the recession is still months away, the Fed's intervention could stabilize the market and drive stocks to new highs, similar to what happened in 1998 when the market surged after a rate cut. What makes the current situation unique is that the VIX is spiking while the S&P 500 remains in a strong uptrend, a scenario we haven't seen before. If the VIX begins to decline, it could fuel a continuation of the market's upward momentum. So, what's next? The future of the S&P 500 largely depends on the timing of the U.S. recession. If a recession hits soon, any market rally might be short-lived. But if the recession is delayed, we could see a significant move higher. Stay ahead of the curve with FinTech News. Subscribe to our channel for more insights and analysis on the financial markets. And remember, in these volatile times, the best opportunities often arise.